What's going on, everybody? So today we're gonna take it up a level. All right. So I'm sure you guys are familiar with market structure at this point, as that was I believe, the third video, the third or fourth video on this mentorship, and I'm sure you guys are familiar with PDRs at this point. Your basic PDRs. We're talking about fair value gaps and order block theory, right? So we're talking about order blocks, breaker blocks, mitigation blocks, all of those order blocks. And I'm sure you guys have gotten familiar with what those things are. I'm sure you guys did your tape reading when I taught you guys how to journal and tape read all the concepts that I've taught you at this point. And I'm sure you guys have went back in time and back tested as well some strategies, and even went back in time to even look at certain concepts, right? If you guys didn't, that is on you guys. That is not on me. It's no sweat off my back. That is all on you guys. I'm giving you guys this for free because I really enjoy teaching people, and I really want you guys to get this shit so that you can use this as a way to extend your way of making money, and so you don't need to worry about making money in the future, worrying about a 9 to 5, and eventually gaining the skill of trading so that you can use this to your advantage so that you can benefit it for financially for yourself. Okay, so in this video we're going to be going over advanced gap theory. Now in advanced gap theory, we will be extending our knowledge of what an inefficiency is and the different types of inefficiencies that there are, because there is a multitude of these. Now, price targets one of two things: liquidity or inefficiencies. So what does that mean? Price will target some type of key level of liquidity, so that's either a buy side or sell side liquidity, or some type of time-based liquidity, okay? Or it will target an inefficiency. So the only inefficiencies that you guys know of is a BISI, a SIBI, and an inverse fair value gap, I do believe. Today we'll be going over pretty much all types of inefficiencies. Now, you will not be using every single type of inefficiency, because that is just an over complication for yourself. The purpose of understanding what these inefficiencies are is so that you can understand why the market is going this way, why the market is coming into this direction, what the market is going up to tap into, why the market is going down to tap into. To understand why the market is going in this direction, or what could possibly the market fill or tap into. Why is the market filling or tapping into that? So we're just going to be going over it and extending our knowledge upon what inefficiencies are, and how we can extend our knowledge of what types of inefficiencies that we know of. Now, I want you guys to take down your notes for this video, and I just want you to be knowledgeable of what we are looking at. Now, when it comes to the real market, we are not going to be implementing every single one of these. We are just going to be implementing the ones that we feel most comfortable and familiar with, and that goes along with the basics as well. So what is advanced gap theory? This is an understanding of how to identify all inefficiencies which are created institutionally and or market algorithm. So remember, an inefficiency is basically some type of area in price that is not operating efficiently with the market algorithm, and that can be affected by the algorithm alone or by institutions manipulating price to create that imbalance in price. So remember, for markets to operate efficiently, right, price needs to be balanced. For price being balanced, both the buy side and the sell side of the market need to be at the same level. For them to be at the same level, they cannot create any spaces in the market. When there's a space in a market, that is an inefficiency. And if we're talking about price being balanced, price is imbalanced because there's a space in the market. Price needs to meet at the same level for price to balance each other. When price doesn't meet at the same level on both the buy side and the sell side, price is not balanced. And same thing for price being efficient and moving efficiently. Price cannot move efficiently if price is not balanced. So if there's an imbalance, price is inefficient. in terms we are talking about the word inefficiency, because price is not balanced, price is inefficient, hence the name inefficiency. So this is also understanding every single type of inefficiency and what they are. So today we're going to be going over every type of inefficiency, and we're also going to be going over what they look like and the purpose as well. So we're going into depth of this as well. So understanding ICT advanced gap theory, we can use this to our advantage for model entries, identifying the draw on liquidity and higher time frame market sentiment. So remember, we can use this to our advantage for model entries. So if we are using a 2022 model, which I had taught you guys, most basic model, I want you guys to master this first. You can replace your BISI with an inverse fair value gap if you so do choose so. You can replace it with a breaker block if you so to choose so. You can replace it with an order block. It's all up to you. It's just expanding your horizon to what makes more sense to you and what you feel more comfortable with. And now I'm not saying to use every single one of these gaps or inefficiencies. I'm just saying to be knowledgeable about it, to understand why price might be going so high and, disrespecting the fair value gap that you were targeting in the first place for an entry. And it might have hit maybe some other type of inefficiency which missed or made you go into drawdown, or maybe even hit your stop loss. So I just want you to expand your horizon to what makes more sense to you and what will, possibly be more comfortable with you. Also, this will help us identify the draw on liquidity. So what is price targeting? What is price wanting to fill? So understanding the draw on liquidity will help us understand why price is targeting this or why price is targeting that, and why price could possibly be going in this direction, and what price could possibly be wanting to fill in, and why it's going into that direction. And also we will be looking at higher time frame market sentiment. So what does the market algorithm want to look for? Market algorithm, market sentiment. So we talk about sentiment, we talk about perspective. We talk about people or psychology perspective, we're talking about people's sentiment. We're talking about market sentiment, we're talking about the algorithm. What is the algorithm targeting? So understanding each one of these inefficiencies and how they operate and what they look like will determine for us what the draw on liquidity could possibly be. Okay? Now, what types of inefficiencies are there? We have, obviously, the main ones that I have taught you earlier on in this mentorship. We have our BISI, also known as our buy-side imbalance, sell-side inefficiencies. We have our SIBIs, also known as our sell-side imbalance, buy-side inefficiencies. We have our inverse fair value gaps, which is an IFVG. We have consequent encroachment, which is not a type of inefficiency, but this is a discrepant of what parts of an inefficiency are. So when we talk about consequent encroachment, we're talking about the midpoint of a fair value gap or an inefficiency. So when you mark out an inefficiency, the midpoint or the middle point or equilibrium of that inefficiency is known as consequent encroachment, and that plays a big role in any type of inefficiency. Okay? Next thing, we have our fractals. After that, we will go over volume imbalances, liquidity voids, NWOGs, also known as new week opening gaps, NDOGs, also known as new day opening gaps, IOFED, which is known as institutional order flow entry drill, BAGs, which are breakaway gaps, measuring gaps, exhaustion gaps, common gaps, opening range gaps, and a mohawk wick, which is similar to a rejection block but is different because it is treated as an inefficiency. So we'll go over this briefly because you guys should have this down already. All right. So a BISI and a SIBI. A BISI, also known as a buy-side imbalance, sell-side inefficiency. Okay. Buy side was offered, but sell side was not present, causing an inefficiency in price. This is known as a bullish gap. We can use these for entries. So remember, BISI, a 3-candle pattern. We have a space in between the first candle and the third candle's bottom and top wick, leaving a space right here in the second candle's body. This space is known as a gap of fair value, also known as a fair value gap. What does fair value mean? Fair value means price has not been in that area for long enough time. So because price has not been in this area for long enough time, it leaves a gap. So it is a gap of price not being in this area for long enough time, also known as a fair value gap. Now, a SIBI, sell side imbalance, buy side inefficiency. Sell side was offered, but buy side was not present, causing an inefficiency in price. This is also known as a bearish gap. We can use these for entries as well. So the same thing with a BISI, just the opposite with a SIBI. It's a 3-candle pattern, but coming down now, leaving a space between the first candle and the third candle's top and bottom wick, leaving a space here, which is known as a fair value gap, also known as an imbalance. Okay? Inverse fair value gaps. So, an inverse fair value gap, a failed or disrespected fair value gap that then acts as support and or resistance for price. A disrespected SIBI will act as support, and a disrespected BISI will act as resistance. We can use this to indicate to us what order flow we are in and where the potential draw on liquidity will be. So we look at an inverse fair value gap, right? If this is our SIBI right here, we see price drops down, creates our SIBI with this candle close, then price comes back up into the SIBI. But what does it do? It closes above the SIBI, which turns this sell side imbalance, buy side inefficiency, or SIBI, into a BISI, which will then act as an inverse fair value gap because this SIBI had gotten disrespected, which then price comes back down. This SIBI will now act as support for price to go higher now. So an inverse fair value gap is basically a fair value gap that gets disrespected, and it is used in the opposite direction to reject price in that opposite direction. And finally, final thing that you guys should be familiar with is consequent encroachment. So consequent encroachment is midpoint, 0.5%, 50%, or equilibrium of an inefficiency. So if we look at this inefficiency here, we have a BISI, 3-candle pattern, 1, 2, 3. This top wick, there's no wick here, but we will count the body here. This is the open of the gap. This is the complete fill of the gap when the market comes back down into price. This midpoint right here, this line in the middle, this is the midpoint of the fair value gap, and this is known as consequent encroachment, or CE, of a fair value gap. And this is important because we want price to respect this portion of the gap and not push past it, as when it does that, it will start to show some sort of disrespect towards it. The wick can go as far as it wants, but we want price to still respect consequent encroachment of the gap with the body. The wicks do the damage, the body tells the stories, hence from ICT himself. So we want price, if it's a BISI, we want price to close, a body close above consequent encroachment. The wicks can go as far as to fucking Neverland that it wants to, okay? But we want the bodies to close above or at consequent encroachment. Once it starts to close below it, we can start to expect us to get disrespect of this gap. Once we get disrespect of the gap, and if we are in a trade, at that point, we can probably intend to pull it at that point. And that would be your decision alone. Alright? Now, let's go over fractals. Alright? Now, fractals are probably one of the most confusing gaps to understand. Why? Because if you're trying to enter a trade, right? You haven't entered a trade and you're getting fucking FOMO. You're getting FOMO, you're trying to push a trade, price is running away from you, you're getting impatient, right? Fractals are the most confusing because you don't know which fractal it's going to target and fill. You don't know which fractal it's going to reject. That's why fractals are one of the most confusing types of advanced gap theory inefficiencies to understand, because it takes skill and also takes experience to understand which gap it's going to fill. So fractals are reoccurring pieces or fragments on price action that we can use for our advantage over the market. So fractal fair value gaps can be used as for forgiving entries, second entries, partials, and or pyramid scaling opportunities. We can also use other PD rays as fractals, such as breakers, propulsion blocks, order blocks, inefficiencies, etc. Okay, so we take a look at this. Imagine this is our gap here, this is our inverse fair value gap. Price comes down, disrespects the fair value gap, right? Comes back up into this inverse, taps into it, right? This is our main entry here. Price comes back down and then creates this fair value gap here. What does price create this one for? There's a purpose for it. This is known as a fractal. This is a second fair value gap entry. If you miss this entry, this is a forgiving entry right here because you missed this entry here. So the market algorithm gives you that opportunity to get back into the market, put on a trade, and benefit from it. Why? Because price needs to grab the liquidity in this inefficiency. Why? Because price is imbalanced. Remember, when we have fair value gaps, price is imbalanced in this gap here. So price needs to balance price again by filling in the imbalance to create price to be balanced and reject it lower to then rebalance. So remember rebalance theory. Okay? With these fractals, you need to know which ones will get filled. And that takes skill. And you guys need to experience that for yourself. You guys need your own experience to understand which gap it'll fill. And you need the confidence to enter a trade on which one you believe it is going to fill based off of your own experiences. Okay? I have my own experiences. ICT has his own experiences. And all of you guys will have your own experiences. But that takes you and yourself to understand which one you guys are going to want to enter on. Now, I'm not saying you have to use these. I'm just saying there's a purpose for price to retrace into these secondary, third, or even fourth or fifth gaps because it needs to balance price again. So, understanding what fractals are will benefit you in the long run. Okay, volume imbalances. Volume imbalances is a type of inefficiency where the body of the candles are disconnected and only the wicks are touching. Price can return to these areas later, sometime in the future. This is caused by having an imbalance of price moving in too high of a frequency that it gave the market an inefficiency. So, because price was moving so fast, like super fast, like a fucking rocket, it didn't get the chance to open right here at the close of the previous candle. Instead, it just jumped in price and opened up here, causing an inefficiency here, which is known as a volume imbalance. And this is where the wicks only touch and the bodies don't touch. Now, understanding what the volume imbalances look like, we can pay attention to these small segments of price, right? And understand why the market is coming back into this area. It might fill this fair value gap here, but the body might close in here and over the gap. Why? Because there's a volume imbalance here. So understanding what these look like, you can understand why price might come into these areas. A liquidity void. A liquidity void is an imbalance in the market where two candles don't touch on both the bodies and the wicks. They are usually created because of too strong of momentum to the buy side or sell side of the market. We can anticipate that these will be reacted or filled in later in the future. Now, a liquidity void is different from a volume imbalance. So when we look at volume imbalances, this is when the wicks only touch. When we look at liquidity voids, this is when the bodies and the wicks do not touch each other. So understanding what the liquidity void looks like compared to a volume imbalance. Wicks touch, wicks don't touch, bodies don't touch, bodies don't touch. Alright? Now, new wick opening gaps, also known as an NWOG. And these are the ones that you want to pay attention to. And these are the ones that I want you to mark out every time you see it. And you will see it every time you open your price or open the market up price. Every time you open the market up on Sunday, you will see this formed. Some weeks we do not get new wick opening gaps. Some weeks we do get new wick opening gaps. But all I'm saying is, when we get these, mark it out. And keep it marked out for multiple weeks. Okay? So a new wick opening gap is an inefficiency that is created from gapping higher or lower by reaction price difference of Friday's closing price going into Sunday's opening price. So when the market closes on Friday, right, 5 p.m. EST, market is closed. But the algorithm already has a designated area of where it wants to open. And when the market opens, that new objective that the market wants to open at is going to be the open, no matter what. And if price wants to open higher, it is going to leave a gap from Friday's closing price all the way to Sunday's opening price. And that gap is going to be known as our new week opening gap, also known as an NWOG. The NWOG can be used as multiple factors such as higher time frame draw on liquidity, support and resistance, and market sentiment. So this new week opening gap, it can be used as support for price to go higher. It can be used as resistance for price to go lower. It can also be used as a draw on liquidity on the higher time frames. But most importantly, this is market sentiment. So if you look at institutions, right? If you look at smart money, institutions target new week opening gaps. They will target the last 4 new week opening gaps. So the last 4 new week opening gaps, they will target that as a new value in price. So these new week opening gaps, when you spot them, mark them out and keep them marked out for multiple weeks on end, because this is the higher time frame draw on liquidity. And the market algorithm will target this, and it'll be projected even with more velocity with institutions targeting it as well. Okay? So a new week opening gap, these are gaps formed from Friday's closing price into Sunday's opening price, creating a big gap, and it'll be worth something to the market algorithm because it wants to be interacted with later in the week, or maybe later in the next week, or the week after that. Just keep them marked out, okay? They are important, and you need to mark them out. New day opening gaps. A new day opening gap is a type of inefficiency that is created by gapping higher or lower during the week. This usually refers to Wednesday's closing price going to Thursday's opening price. Now, Wednesday's closing price is between 4 to 5 p.m. Thursday's opening price is between 7 and 8 p.m. Okay? So it can be anywhere between these time frames, okay? So instead of Friday's closing price to Sunday's opening price, it's going to be from Wednesday's closing price to Thursday's opening price. And now, new day opening gaps do not get formed all the time. Same thing with new week opening gaps. But when they form, mark them out. And dogs can be used as multiple factors, such as higher time frame draw on liquidity, support, resistance, and market sentiment. So the same thing how algorithms, or the market algorithm, and institutions target new week opening gaps, they will do the same thing with new day opening gaps. So every time you have a new day opening gap, mark it out, because it wants to get interacted with later on. And I can promise you, it will get interacted with. So mark these out. And this would be from Wednesday's closing price to Thursday's opening price. IOFED. IOFED, also known as Institutional Order Flow Entry Drill, is an action that the market performs on specifically fractal gaps, which are partial entries to reach higher/lower levels of liquidity. This is where the market wicks the gap and not closing inside of the gap at all. We can use this to identify bullish/bearish order flow and take advantage of this to use for pyramid scaling. So if we take a look at this fair value gap here and this fair value gap here, what do you notice? Did it fill it? Partially. This is a partial fill. So IOFED, Institutional Order Flow Entry Drill. This is when we have a partial fill of a fair value gap by the market just wicking it. When you have a glass of cookies and milk, right? You have an Oreo. Do you dunk it or do you dip it? Me personally, I dunk it. But some people, they dip it into the milk, right? That's what you want to be imagining when you look at the fair value gaps, okay? You want to dip your cookie into the milk, just like the market wants to dip the candles by the wick into the gap. It doesn't want to fill it. It doesn't even want to close in it. It just wants to tag it, right? Okay? So an IOFED is when the market just partially fills it, just taps into it. Doesn't need to fully have a wick through it. It doesn't even need to have a body close through it or in it. It just wants to tap it. And on top of that, these will usually be occurring on fractal gaps. So secondary and third gaps that formed. If this is the original gap, it'll be tagging fractal gaps, partially filling it. So understand that IOFED will most likely occur on fractal gaps. And once you spot it, identify it, and accept it as what it is, which is IOFED. And this is why we do not enter at consequent encroachment of gaps. That's why we enter at the open of them, because this could possibly happen. You know, you see influencers that enter at the close of the gap, or they enter at the consequent encroachment of the gap. Yeah, it could possibly fill it all the way, but will it all the time? No. This happens so much, so many times. So many times this happens. You get tapped, or the market taps into the gap, but it doesn't fill the gap all the way, and then you just miss out on the whole move right there. Why didn't you enter on the open? Oh, because I was trying to get a better risk to reward ratio by entering a consequent encroachment of the gap. Well, then risk less, obviously. If you are worried about your risk being too high, risk less. Risk less than you originally are risking so you can at least get your entry. If this happens and you're entering at consequent encroachment, or even here, you're entering at the close of the gap, you're going to miss your entry. You're going to miss out the whole move, and you're going to feel like crap, and then you're going to feel like FOMO. You're going to be like, oh, I should have entered at the open of the gap. Yeah, you should enter at the open of the gap all the time. Oh, but Pono, my risk to reward is going to be a 1 to 2. So fucking what? You got your entry. It was a good setup. You didn't get your risk to reward that you wanted. That's because you're aiming too high. Remember what I talk about. Build up your tolerance. Start out from getting 60 ticks. Move up to getting a 1 to 1. After that, get a 1 to 2, 1 to 3, 1 to 4. Whatever the market gives you, you take that. Do not be greedy. Okay? So, IOFED. This is when we wick a gap partial fill. And this is why we enter at the open of gaps. Alright? Now, a breakaway gap. A breakaway gap is an inefficiency that occurs when price breaks away from a significant level, leaving a gap in its wake. These gaps are often seen at the start of significant market movements and are usually accompanied by high trading volumes. They are considered strong signs to show a shift in market sentiment. Bags or breakaway gaps will want to stay unfilled or unmitigated. So, breakaway gaps are usually formed after the main target or PD ray has been filled. Once it has been filled, this breakaway gap will usually occur. How do you know it's going to be a breakaway gap? You will usually have a gap that is created, and you will usually get displacement through a high without filling the gap after it. And that is after you already filled some type of other gap. Okay? That is usually the occurrence that will happen. You will usually have filled a gap, an original fair value gap. You usually create a second fair value gap. But before that second fair value gap can get filled in as a fractal, it's going to get displacement through a high, an intermediate term high, and it's not going to tap back into this breakaway gap. So you see we tap into a fair value gap here, create our secondary fractal gap, but since we get displacement through this high here, this is going to be a breakaway gap, and we can anticipate it. We can anticipate it happening. And you see price comes down, disrespects this BISI, but it's going to target this breaker block here, which it fills and taps into, but it does not fill the breakaway gap. And the breakaway gap, it wants to stay unfilled. And this is a good indication for us to be bullish. And this works bearishly, but we're just paying attention to this example here. So this is a good bullish indication for us. Now, a measuring gap, also known as a runaway gap, is like a breakaway gap. But after the breakaway gap has formed, there is little to no correction with it. This would typically be a continuation gap and have accompanied volume with the continuation. These will usually want to stay unfilled, but they do have the possibility of getting tagged and filled. We can use these to show indication of order flow and direction. So when we pay attention to breakaway gaps do not get touched, they do not get filled. Measuring gaps act the same way. Only thing is they have the possibility of getting filled. So you see these big impulses right here. These big impulses right here. Those are measuring gaps. These are measuring gaps right here. These big impulses in price, leaving, two fair value gaps. These will usually stay unfilled, but they will have the possibility of coming back into to get filled to then later continue in the intended direction. Same thing here. We impulse down and we do not fill it all the way, but then we come back into it to have the possibility of coming down lower. Same thing here. We have a runaway gap, also known as a measuring gap, created here. Market comes up, has the possibility of filling it to then continue higher. Okay? So, a measuring gap is a big gap, like a big length in price of a gap that has the possibility of getting formed with a fill, but does not need to. It depends on what the algorithm wants to do, but when we spot these measuring gaps, right, these big impulses in price having like multiple gaps, like two, or just one big gap, it's usually not going to get filled, but it has the possibility of doing so if price wants to go even more in that direction, and in this case lower, right? An exhaustion gap. So an exhaustion gap is price's last attempt to reach higher/lower prices, but failing to reach any significant distance in price to then only reverse. We can use these as an indication of order flow, direction, and potential reversal bound to come or bound to happen. So when you see this gap right here, it's going to look like a volume imbalance, but we create a big wick right here. That's going to be an exhaustion gap where we have our last gap in price, but we fail to make any significant volume increase to the upside in this example, right? So we have a gap here, we create a big wick, and this is where we create our exhaustion gap, and this is what it's going to be looking like for us. Now, exhaustion gaps, I don't personally use these, but you can if you like them. I do not personally use them, but I'm just giving you an insight of what they look like so that when they come up, you can identify it. Common gaps. Common gaps are also known as area gaps, are the most frequently occurring type of gaps. They're usually filled quickly, meaning the price returns to the gap level and trading activity resumes within it. These gaps often occur in the range of a market where the price is moving sideways. So when we pay attention to common gaps, these are going to be the most common, right? They're going to be the most ones that are found. So whenever the market is consolidating or market is pre-market or accumulating price or liquidity, right? You're going to be seeing these common gaps forming a lot, all right? When you see these common gaps forming, they're not significant to you, okay? So do not think this is a liquidity void. Do not think this is a new day opening gap. Do not think this is an exhaustion gap. Do not think it's a new week opening gap. These are common gaps, and these will be forming on the 1 minute, 30-second chart, etc. So do not get enticed over this, being like, oh, price might want to come down and fill it, and this is going to be the draw on liquidity. Price is always going to want to fill these. So don't get enticed about common gaps getting filled compared to a fair value gap getting filled. A fair value gap has much more significance than common gaps. Okay? Opening range gap. This is something you guys need to pay attention to. Okay? So opening range gap. This is the difference between yesterday's closing price to 9:30 equity opening price. You can see this by comparing regular trading hours to electronic trading hours. Price will usually want to react within this range. Now, we are not talking about Forex here. Fuck Forex right now. Fuck Forex for just this one. You cannot use this, or you can, but this is specifically talking about futures, and specifically indice futures. So with indice futures, markets close at 4 p.m. EST. Markets open 9:30 EST. And this is using regular trading hours. When we're on TradingView, this is electronic trading hours. So you are getting an insight of what stock market people do not see. You get an insight of pre-market, which is why you are able to do an analysis. When the market opens on, let's say, SPX, right, they do not see pre-market data. They only see opening of the market, when the market is open. It's going to be from 9:30 to 4. We see pre-market data with futures, which is why we're able to anticipate an analysis based off of whatever we mark up. So, price will usually want to react within this range. So remember what I said about consequent encroachment. Consequent encroachment is midpoint of any gap. Since you're marking out from 4 o'clock to 9:30 equity open, the midpoint of the gap will usually want to get interacted with, as well as the full fill of the gap we usually want to get interacted with. So wherever the closing price is, depending on multiple factors such as daily bias, intraday market profile, etc., price will usually want to interact with the consequent encroachment of this gap. Whenever you have an opening range gap, you're usually going to want to mark out consequent encroachment of it between 4 o'clock and 9:30. Later on, I'll show you examples of how to do this, but price will usually want to interact with that. That's why you can anticipate market open at 9:30 based off of opening range gaps. This is why this is one of the most important types of gaps that I want you guys to understand. Okay. Now, a Mohawk wick, this is similar to a PDRA known as a rejection block, but it is used by the wick to reject higher and or lower. The wick can act as real support and resistance, and we want price to respect 25% of the wick or 50% of consequent encroachment of the wick. Using this on higher time frames would be focus for these. Alright, so if we pay attention to here, this is our Mohawk wick here. We measure out premium and discount of the wick, we have consequent encroachment. We measure out premium and discount of consequent encroachment, we get consequent encroachment of consequent encroachment, which is going to be 25% of the wick. At 25% of wicks, and we will usually be using Mohawk wicks on the daily time frame, okay? Daily time frame. That's where we be predominantly using Mohawk wicks. Price will usually want to reject 25% of the wick, not consequent encroachment of the wick, 25% of the wick, which is consequent encroachment of consequent encroachment. Okay, so price will usually want to reject this area to go lower or higher depending on what type of Mohawk wick it is, whether it's a bearish one or a bullish one. And if you look at a rejection block, they are very similar, but this is the difference, 25%. That is what price is rejecting when it comes up past an order block. That's your last line of defense, right? Your order block before, changing its order flow, right? And then it comes up into this long wick and then rejects the wick. Why is it rejecting the wick? It's rejecting 25% of the Mohawk wick. Okay? Finally, our cliff notes, alright? We don't need to use every single one of these gaps, okay? So all these gaps, you don't need to fucking use all of this. Only ones that I want you to use is going to be the new week opening gap and the new day opening gap, alright? Understanding the difference between each one to be specific with executing the right ones is the benefit to knowing these. Knowing the purpose of each of these can benefit us with forming our perception of where price could be going to and reacting to. Understanding advanced gap theory is not the be-all end-all for trading, but it will certainly help us develop into having a solid edge over the market. Using these concepts with things like time and price theory and daily rebalance theory will help us understand what the market could possibly do. Okay? So, overall, I want you to combine what you have learned and just be knowledgeable about what type of gaps there are. You don't need to use all of these gaps, but understanding what they look like and what they are will benefit you because you can understand what price is targeting and what price could possibly be going into. And it'll mix up or not mix up the confusion with you of what price is doing. Okay, so knowledgeable about gaps. Don't use them forcefully. Use them periodically of what you prefer. Not me, not anyone else, but you personally. Okay. Other than that, I hope you guys found this video interesting, and I hope you guys took down notes, because if you guys didn't, you guys are gonna have to watch this all over again, and that's gonna be a lot of work for you guys. Okay, so hopefully you guys took down notes. Tape read, back test this, and all of these gaps. Other than that, I'll see you guys later. Peace.